Let's talk to Craig Erlam. He is a senior market analyst at OANDA. Very good morning to you, young Craig.
Morning.
Right, we have one thoughts-provoking slide to run through, the Great British Pound against the Canadian dollar. The pound seems to be a theme for everybody, on everybody's lips, newspapers, etc., this week. What's going on against the CAD?
Yeah, everything's very pound-centric right now, and this week's no different. Typically, I was tempted to come in with a pound-dollar chart, given the fact that we've also got Fed and non-farm payrolls this week, but I think we've taught that to death at this stage.
And Bank of England.
And Bank of England, which is, again, what makes the pound so interesting. And I think against what I like about this chart, very different to the pound-dollar, is that it's quite contrasting in that this is actually looking a lot weaker than pound-dollar. We've talked previously about the fact that the pound looks like it could potentially be bottoming against the US dollar. Here the story is very different. We've had loads of bearish technical breakouts. We had the breakout of the rising trend line a while back now. We had support around the 200, 233-day simple moving average band, which you can see in red along the bottom. We then pulled back to the 50 fib, so a lovely little technical rotation off the 50 fib there, which also coincided again with the 55.89 band. Again, not standard moving averages, but I like using Fibonacci on my charts, as you can quite clearly see. And my moving averages are no different, and this is one of the occasions where they've worked very well indeed. We've rotated off there, now broken below the 200, 233 band. We're now testing the lows once again, but this is just looking nicely bearish. If we look at the momentum indicators, very supportive of the most recent decline, and if we can just break through that 170, and again, technical levels, you tend to be looking for fibs or maybe moving averages, whatever, previous support and resistance, but these big round numbers do play a role as well, and it's not a coincidence that we are just finding support around that 170 again. And I think breaking that 170, I wonder how many stops are going to be triggered, for example, for people who are still bullish in this pair, and what kind of momentum we could then find below.
Okay, so the technicals are looking quite weak for this currency pair. What about the fundamentals?
Well, that's the interesting thing right now. Fundamentally, I'm looking at something like the pound dollar and saying that there's reason to be bullish here. A lot of pricing in the US, not enough pricing in the UK. We're looking at this pair, and I'm thinking, well, how can I be bullish one pair, the pound against the dollar, and not bullish against pound against the CAD? It seems counterintuitive. But I mean, I just think this is a CAD dollar story. I think the Canadian economy is slowly but surely getting better. We are seeing the inflation figures pick up. Oil being at these high levels is supportive of the Canadian dollar as well. So it's a slightly different story. I wonder with the Bank of England decision, 90% now priced in for a rate hike tomorrow, will we see some profit taking on that decision in the event that they do raise interest rates? Or shockingly, and I don't think this will happen, if they don't raise interest rates, what will that do to the pound? This could be the trigger to pull this pair back below that 170 level, and that doesn't mean we have to go back to 160 necessarily. 178 is the next level of support, maybe 176 below there. We're not talking necessarily massive moves below, but this is certainly looking bearish in the near term. Potentially some profit taken on that Bank of England decision could be that next trigger to pull it lower.
Okay, so what would you do if you were Mr. Carney this week?
If I was Mr. Carney, I think I'd have done something prior to this week. I think they've left it too late to change their mind right now. I've said many times, this is the wrong time to be raising interest rates. The economy isn't particularly strong. The labour market does look tight, but I'm wondering if those are temporary factors due to the Brexit referendum, Europeans
moving back. But there's no wage inflation, right?
There's no wage inflation. The economy's only ticking along. We're not exactly in a booming economy. This isn't a hot economy by any stretch of the imagination. A huge level of uncertainty around Brexit right now. I don't see the reason to be raising interest rates now, when in 3 months we should have a much better idea of whether we're heading for no-deal Brexit, good deal Brexit, soft Brexit, hard Brexit. Why rush this decision? I feel like the Bank of England, if they raise interest rates tomorrow, they are taking a punt. They are saying we are taking this decision in the hope that we are going towards this kind of softer Theresa May style Brexit, and we won't live to regret this. My fear is that this Theresa May Brexit seems to be a bit of a non-starter at the moment. This may change, but we get to November and they're forced to reverse course, and that's far more embarrassing than losing a little bit of credibility. They should have acted on this a long time ago. They should have said we're waiting till the end of the year. They haven't. They were rushed, and I think they're prioritising credibility over what is ultimately the correct decision.
On that note, Craig, thank you very much indeed.
Thank you.